Gertrude Tumpel-Gugerell is a career central banker, both in Austria and then in the Eurozone. She was an executive board member of the European Central Bank right up to 2011, and very much involved in the whole process of building a unified financial infrastructure in the Eurozone from its inception. Today, she is the chair of the expert group on debt redemption in Eurobills, an attempt by the Eurozone to build a bond market, if you will, eventually that is pan-European in its nature. All of this resulting from the learning that the Eurozone has done leading up to where it is today. What can we learn from the Eurozone, and what's applicable to other regions that are thinking about a unified market? You've seen the European story from its inception and then right to the crisis and the way forward today. Given the role that you've been recently given, is the idea of a European or a pan-European bond market desirable? Or are there things that we have learned from the sovereign debt crisis of the different European crises that we still need to tighten in order to make sure that we have a sustainable market?
We have to look back 2 years from now. At that time, there was really a big tension in Europe about financing of states, and some countries had to pay very high interest rates to get financing in the markets. And at that time, two proposals were made. The first one was the debt redemption fund. This was the idea that a common fund, a joint fund, would buy up government debt and help countries to get lower interest rates, because it would be an average interest rate they would have to pay, not the high interest rates they were charged. And this should help countries to bring down their debt overhang. The second idea we have discussed, and which was proposed at that time, was a Eurobill fund. This would be joint issuance of short-term government debt. The advantage of the proposals would be that we would create a safe and liquid asset in the market, which would be very useful for liquidity holdings, and would also help banks to diversify their assets. But there are also risks in these proposals. For instance, the risk in the debt redemption fund is that countries would make a commitment for 25 years and make a fixed commitment to repay that debt. And this would be risky to a certain extent, because you cannot forecast exactly the business cycle for such a long period. Nevertheless, it's important to keep in mind that we have progressed very far since 2012, that interest rates have come down again in Europe for government debt, and that we are now in the process of establishing the banking union, that confidence is coming back to Europe, and also growth has picked up recently. It's still low growth, but situation is improving.
Well, in a way, this is like trying to deal with the aftermath of a flood while the water is still receding. There is the question of banking union. There's the question of the role of a lender of last resort in the European model. And there's a question of who holds this debt. At the moment, in some of the countries, it is still the banking system. So it's a vicious cycle in a sense, and the countries haven't figured out how they want to get out of that vicious cycle. And on top of that, it's really any debt market is only as good as the balance sheet of the countries that bear them. And here, the role of Germany and France in holding the value and the quality of the debt is still central to the whole process. Would you say that, or is there a way to move to a new model?
I would agree with you that if banks hold too much of their own government's debt, they are binding their fate with their own government. We call it the doom loop. So in a situation, what we have seen during the crisis, that if banks have a lot of their government's debt, if they a government faces difficulties, the banks get into difficulties as well, or vice versa. If a banking system has problems like in Ireland, then also the government quickly gets into difficulties when they try to support the banking system. Therefore, it would be important to go on this financial integration, that banks are holding the debt of various countries, not so much only of their own government. But the most important thing is that governments make progress in fiscal reforms, that they consolidate their budget, and we have made, I think, great progress in bringing down the deficits compared to the years 2010 to 2012.
Well, so if being someone from the central bank side of the equation, are you satisfied with what governments are doing? What's the conversation and the quality of the conversation? Will a Greece happen again?
I think we must acknowledge that there is now a new fiscal governance framework, much more binding rules for the governments. They have to come up with a medium-term plan, and if they are not respecting their commitments, they get sanctions, and they have even to pay fines. There is progress, but not all countries have made the same efforts. Some countries which were under strict surveillance and strict monitoring, like Ireland and Portugal, have made more progress than other countries which didn't have this strict monitoring. So certainly some countries like Italy and France, they have to do more.
What about the infrastructure to trade such a pan-European bond market? Does the infrastructure exist, or is there something that needs to be built?
I think it would, in case such an idea would be realized, I think it's very much a medium-term perspective. Then you would have to set up a joint issuance, a debt agency, for instance, and of course major market makers would have to be selected. Do
you talk to the trading community, the people who trade in sovereign debt, whether such a bond is required? And the bonds are not long-term bonds.
Not long-term. Our mandate was exclusively for 1 or 2 year bills.
Is that a test type of a
could be considered like a test, yeah.
Right. Is there a desire to make them long-ended?
It's very controversial. Yeah, some governments are very much against long-term bonds. So, like German government is very skeptical about that. Therefore, short-term bills would be kind of first trial, and we have talked to market participants. I think it would be well received, is our assumption.
Yeah, but do you have a very clear idea of the use of such bonds? What would it?
These bills, yeah, let's call them bills, like the treasury bills in the US, they could be used for liquidity holdings, and liquidity is a very important element also in the new supervisory framework. And they are very fungible. They are easily to be exchanged against cash or central bank money.
Right, but given that it is very clear that it's for liquidity, the inflation regime in the different parts of Europe are not necessarily manageable from a central perspective.
They are. We have one monetary policy, and we have individual fiscal policies. Fiscal policies so far are coordinated only to a certain extent because countries have to respect the balanced budget rule in the medium term or balanced budget rule over the cycle. So this is a common element, but there is no interference from a central, let's say, European Commission or the governments into other countries' budget policies. And of course, if one would one day consider joint issuance, I would assume that governments would also want to have the right to interfere in other countries' budgets.
What sort of size are we talking about?
Euro bills, our calculations show that it would be around 500 billion. If you take current short-term issuance for up to 1 year.
Will that in turn absorb some of the debt that is being issued at the national level?
Yes, it would replace the national debt.
The intention is to replace it altogether.
This would be the intention.
And those who participate then therefore give up the right to...
Yes, yes.
Okay. We're having this conversation at a time when different markets are thinking about the European model. And in Asia, there's a lot of talk about an Asian financial infrastructure, and in ASEAN, there is this ASEAN 2015 and so on. In retrospect, in having seen all that you've seen as a central bank executive board member, would you recommend that the bond market is a very good place to start in order to, to start the coordination required to create a common market?
I think you have to have an overall strategy. And what we did in Europe was first to start with the single market. The 20 years ago, the single market project meant freedom of traffic of persons, people, goods, services, and capital. Capital is not easy to liberalize, and this was the so-called Financial Services Action Plan, which first of all allowed to spread banking services over the Union. It is possible now in Europe to have one banking license and do business throughout the Union. This is a very important step. Of course, capital market integration is quite delicate because you need legal harmonization and you need proper surveillance. It's the same as with banking services. And then in addition, you should also have a common infrastructure, or infrastructure which allows you to do business smoothly and at good conditions. I think it doesn't make sense to start with one element only, but to make a consistent plan.
The reason I asked is that in the European Union story, there was a motivation for creating common market and goods and services and people, and the European history, given the European history. In almost all other markets, there is no that commonality. There is no that overarching mandate that a common market is good. But when you look at what Europe has gone through, where it got into trouble was the capital market infrastructure. It wasn't so much all the rest of it, and when you look at what other regions are trying to do in creating harmonization, there is still not that motivation to create payments infrastructure, for example, or even give access to each other's banking system. So what I'm saying is that is it desirable for other markets to start from the other end of the story and build it backwards? Because the bond market also creates the common market, but also the legal infrastructure, the documentation, standardization process, and all of that. And then it sort of creeps into, if it becomes successful, it creeps into the fiscal policies that have to be aligned and so on. And it also appears that in Asia, at least, the bond market initiatives are going further down the road in creating bilateral arrangements rather than anything else. So that's why I asked this question.
I think the dominating motivation is integration of trade and intensification of trade. If you think of Europe, for instance, a country like Germany has a similar amount of trade with small neighboring countries like my home country, Austria, or the Netherlands, as it has with China. This shows how much trade is taking place within Europe. And to do this in a smooth way, of course, financial integration helps. We are, in a few months from now, we are opening the single European payments area. This means with one account, you can do business throughout the Union, immediately, instantaneously. And this is a huge advantage. Yeah? You should not underestimate that. Capital market integration is important for two reasons. If you have, for instance, a pension fund which invests in various markets, of course it helps when you can do it smoothly, when you have a common infrastructure, when you don't have to pay high fees for settlement in various markets. And therefore it is worth considering also capital market integration. Of course, a different story is common currency or common economic policy. This is much more far-reaching and requires really the political will to follow similar economic policies.
Right. The European approach was to give a lot of power to the administrative process, the European Central Bank and the European Union itself. If you take the American model, and if you take the U.S. as a commonwealth in its own right, it took the commercial model where it didn't dictate prices, it didn't dictate access. It just liberalized and allowed the market to to define for itself. Is there a middle ground where regulated versus a liberal policy can meet, where you allow the market to decide how it wants to evolve?
I mean, if we compare Europe and the United States, we can say that also in the United States, financial market integration is a rather recent phenomenon. They had more decentralized markets, and they have, in the last 20, 30 years, undergone also an integration process. Of course, it's easier to do it within one country, within one legal system and jurisdiction. But I think in the end, the US also shows that the integration has helped them to get a stronger banking system. And in Europe, we have the difficulty of having different legal tradition, legal systems, and therefore it was not so easy, and legal harmonization is not a small thing. Nevertheless, I think it has paid off to go this route also in Europe. And if we look back, maybe we have not gone far enough in financial integration, because if you look at countries and financial systems which have come into difficulties, usually a banking system has troubles when it is investing too much in the same region, in the same product, and is facing a kind of cluster risk. And this is what happened. Spanish banks have invested too much in their own country, and this was the same in other countries.
Well, I mean, that argument is interesting because it is the job of a bank to be fully invested in its local community.
Yeah, but not only. Yeah, not only. And of course, if you invest too much in your own region, you have the risk. If you have a downturn, the whole system can sink, and then you have a systemic risk.
Yeah, so I guess the motivation is to diversify them or give them options for diversification if there is a crisis in that regard. But the market is very interesting. It always looks for the weakest link to attack, and then so whatever you create in terms of infrastructure, the market will find a soft spot to attack. And so by creating this bills marketplace, you're actually raising the stake and making it more of at a more of a European level systemic risk, maybe.
What is clear is that your economic policies have to be credible, and sound. This is the best protection against any crisis if you have sound economic policies. And there we clearly have made mistakes in the past. After the creation of the single currency, the euro, some countries benefited from the low interest rate environment, but did not keep their economies competitive enough.
Yeah, but at the same time, you want it to be sound, but you also want to give them the option to pursue different economic policies, which are commensurate with whatever the local issues are. I mean, in Eastern Europe, it's in a way it's emptying out because the employable population is moving west. They need to make themselves attractive to investors, and their proposition would be more the cost-based proposition. A German proposition would be different, and a French proposition would be different. So that freedom to tweak policies to make them relevant to local needs, is that being surrendered?
No, not at all. I mean, at the moment we have common rules in the sense of how your budget balance should look like, but you can spend and tax whatever you want. It has to be consistent. You should not have too high deficits, but in the end, how you compose your budget on the expenditure side and on the revenue side is really left to the local governments.
Right, and on the common passport for banking, there's this platform now where a bank can become European just by being located in any one market, but at the same time you're controlling prices in terms of payments, in terms of...
No, we are not controlling prices. We want to open the market because, for instance, the market for banking services is usually protected to a certain extent, and what we wanted to do with the common infrastructure on payment services and capital market infrastructure is to avoid that cross-border services is more expensive than domestic service. This is the main intention. We have no price controls.
The reason I ask all these questions is to discover to what extent the European experience can be transposed or can be a learning point for other regions that are thinking about integration. And the big thing about the European story is really there was a plot, there is a mandate, there is a desire to create that greater unification. In fact, anyone looking at Europe from outside, especially the Americans, who at one point were thinking that the euro cannot hold and it will die, it held for only one reason, because you wanted it to. And when we look at other
but why should companies want to give up a huge advantage? Yeah, and the huge advantage is certainty in planning their prices, in planning their pricing behavior, because they know when they export to various countries, which is still the major part of their exports, they know that there would be no changes in the exchange rates.
So the corporates are supporting your process because that common market theme is continuing to grow. And that's because you have the corporates that can benefit from this. And
therefore I think we should not underestimate this benefit of avoiding exchange rate uncertainty and also of reducing transaction costs. If you intensify the trade relations between countries, you will see it's certainly an advantage of having lower transaction costs.
In fact, the fact that you have the euro, you've eliminated that exchange rate difficulty. But let me ask you this as a regulator who's been involved in building infrastructure, financial markets infrastructure. There is at the moment that effort to bring the OTC trade onto and I guess that the bills market will be highly regulated and transparent. What is the new frontier of markets infrastructure? You mentioned exchange rates, but interestingly, where the banks are today making most of their money is from the fragmentation of the FX market and the complete lack of transparency on the FX market. Is that something that you think about in the Eurozone, or is that something that you don't think about anymore?
I think transparency is a very, very big issue. Having more transparency in the OTC market was one of the major progress in financial regulation reform in the last few years. Transparency in the shadow banking system, I think, is an important element too. What we see in Europe right now is building up a common supervisory structure is a huge undertaking, but should also increase transparency. I would see the challenge in near-bank, non-bank sector in the years to come.
Gertrude, thank you very much for spending time with me this morning.